Hello, dear listeners, and welcome to another episode of the Property Trio. I am your host, Mike Mortlock, and today I'm joined with my two fabulous co-hosts who aren't called Cate Backos and David Johnson, which are names that I've heard them called recently in the last couple of weeks. It's Cate Backos and David Johnston. The T's important.
It sure is. Thanks for pronouncing our names correctly, Mike.
Cate, you're just on mute there at the moment, so that has given me some good shielding from any hate mail that you've shared. But how are you?
Yeah, really well. It's so funny you say that. I had a journo call me yesterday. Oh, can we interview? I'm sure it was 3AW, so I knew it was live. And I'm just about to say Cate Backos, and I said it's Bakos. But it's funny because that's the Australianised version of it. My husband's European family will say Bakos.
Oh, Bakos.
Yeah. Yeah.
I think you're going to regret telling us that because Dave and I are immature.
I'm waiting for it,
and we're going to use that. We're going to use that against you. We've got a fair bit to get onto in this episode. This is a listener question from the lovely, shall be named Alison, who had some comments about loving the show, and she's interested in some insights into what would happen if there would be things like rent freezes and planning changes and those sorts of things. So we'll take on that advice, but I'll just launch straight into her question, and we've got some awesome prep that you guys have done for this one, so hopefully there's a lot in it for everybody today. Alison says, "Hi team, I had a question last year about whether I should buy back on beachside of Nepean Highway. My daughter and I lived in Beaumaris, sold and bought on..."
I love it. Beaumaris.
Beaumaris, speaking
Bowie.
of pronunciations.
Bowie.
Bowie to the locals.
All right, pipe down Backos and Johnson.
Backos.
Backos. Backos.
Back off, Backos.
How does it go, Beaumaris? I love it.
What? Beaumaris? Are you serious?
Yeah.
Bain-Marie. We lived in Bain-Marie. Gosh, let's just derail this whole thing.
Yeah, we're being mature now.
Beaumaris. For whatever reason. Sold and bought on non-beachside in Mentone. Have I got that right?
Yeah.
But found that our life was mostly on the beachside, and the back and forth was adding a lot of time to our day. Plus, had bought a 4-bedroom house, which is a bit much for the two of us. So I took the plunge this year, rented out our 4-bedder, and bought a 3-bedder back on the beachside of Mentone. Her current status is she's a single parent who is self-employed, running a consultancy business. Last year turned around $535K. Well done. But unsure that it'll carry over into this year, aren't we all? Mentone, the 4-bedder, is rented out approximately $1.25 million value. The house, she's got a house in Bass Coast, 600 metres from the beach, rented out to a long-term renter, approximate value $550K. The townhouse in Mentone, which is her principal place of residence, has an approximate value of $1.2 million. Alison also has about $1.1 million of lending debt on the two properties. Her question is this: given all the land tax changes and possible changes to planning laws and rents, etc., do I hang on to the 4-bedder and wait until it has had enough value to clear my principal place of residence mortgage, or hang on to it for the longer term? Past 6 years until it is earning, or hang on to the long term past 6 years until it is earning me money. It won't be for a long time. I'm almost 47 years old. I know previously the advice had been to do this, but circumstances are looking like they are changing in a big way for investors. It's a lot of pressure on me as the sole breadwinner, and I will admit I'm a little spooked by all the changes. Obviously, with interest rates, I'm contributing a fair bit to the mortgages, even with the rent. I want to start with your insights into what a sad state of affairs it is that this investor can't execute her long-term plans because of the politicians fiddling around the margins, removing certainty from people. You're not supposed to talk about religion or politics. Let's start with politics.
Well, you know what? We've had a lot of talk about some of the stupid ideas that have come from state pollies of late, particularly our state polly. But I'm really pleased for Alison, first and foremost, that she did take the plunge and bought back on beachside, because we tackled this listener question, and that was my thinking, that if that's where your heart is, that's what you've got to do. So the real question is, do you keep your old PPR or not? And it's on the inland side of Mentone, which, for anyone who doesn't know that southeast stretch of Melbourne, you're probably about half an hour away on the train from the CBD. You've got the coast on the other side of the highway, Nepean Highway, and it's quite a drive from Nepean Highway at that point to get to the coast, because you've got Beaumaris. And when you go
Beaumaris, as they like to call it.
when you go inland, you've got Moorabbin Airfield, and there's a fair amount of amenity around there. There's schools, you've got access to Eastlink and the Peninsula Freeway, and you've also got thrift park shops and a few other things. Boundary Road along the back takes you through all of the industrial area, so it's a pretty well located, easy to get around kind of area. The question is, will this property perform for Alison in the medium term, so that the pain of holding it while we're going through all of these, additional taxes and higher interest rates than we've been accustomed to, will that be too painful? And I also can read that, as a single parent and a self-employed person, there are two things that will compound a little bit of fear and anxiety for anyone. I totally get it. But the real question is, how much longer does Alison love doing what she's doing for work? What does next year look like, for the books? And my thinking is that some of the stuff that they're tinkering with from a land tax point of view is still a small impact in the scheme of things. I don't want to sidestep the issue that it's a stupid tax, but this temporary tax that we're talking about isn't going to necessarily break the bank for one investment property. Granted, Alison's got two, so there's a double barrel there, but with the value that she's mentioned for the Bass Coast property, it's not going to be a really nasty whack of tax. And her earnings last year were really good. So I'm tempted to say, wait it out and see how your earnings look next year, see how you feel, unless, of course, you're saying, I don't want to do this for very much longer, and I can see that my horizon for retirement's really close.
Yeah, look, firstly, I'd just like to say to Alison, well done for being a single parent, owning 3 properties and running a successful business. Such an amazing effort. I completely understand why you might be feeling a bit unsettled with all the changes and conversations surrounding landlords. It's a bit disconcerting, isn't it, really? According to the Australian Landlords Association, I think we touched on this recently, landlords own more than 80% of all rental properties. And despite that significant contribution, it often feels like landlords are somewhat overlooked or even trampled on in the discussions focusing on these challenges for renters. Much like Alison, most landlords are mum and dads. They're trying to get ahead, set up themselves to not have to rely on the government for retirement, to be able to look after their children. And, they're made to second guess things and, feeling like this, they're putting themselves under significant pressure during their lives to take on greater risk. That's providing supply for renters, the vast majority of supply for renters, and they're just completely forgotten in nearly all the conversation. And it feels like, it's supposed to be a good thing that we're trying to get corporations to take on more of these investments, when if we actually looked after landlords more, we probably wouldn't have this problem that we have. So look, that's my sort of 2 cents worth on that part before we get into tackling in a bit more detail Alison's queries and her situation.
Yeah, that's good. I mean, I was keen to hear from you guys on this point, and wanted to highlight something that's just come out, which is the PIPA Investor Survey for 2023, the Property Investment Professionals Association of Australia. I think it's just Property Investment Professionals Australia, isn't it? There was a really beautiful graphic that said where investors have sold at least one investment property over the last 12 months. and it was 40% for Queensland, 31% for Victoria, compared to 20% for New South Wales, and the next highest was 9% for WA. So Queensland and Victoria have probably seen some of the most ill thought out policies around investment, and investors are voting with their feet. Now, these are policies presumably designed to alleviate rental affordability constraints, but they've actually reduced the rental supply. So if that doesn't sort of give them a bit of a wake-up call, I'm not sure what will. Dave, when it comes to Alison's question, so obviously from a planning point of view, you've got to be able to look at the short-term challenges and the perceived external risks. So what are the highlights for you?
Well, look, firstly, I just want to start with providing a picture of her asset base and what it could look like if she held property. So that's one of the first things you'll do when you're mapping out someone's property plan. So if we look currently, Alison owns $2.92 million worth of property, and she's aged 47. So if we factor in compound growth rate on those properties, 5%. So some would say that's reasonably conservative. Some might say it's too aggressive, but I think 5% is reasonable. Yeah. By the age of 60, so in 13 years, her properties will be worth at 5%, $5.36 million. So that's close to double the asset value today, where she's obviously feeling quite tight. At 65, when, a common retirement age, they'll be worth $7 million. At age 70, if she managed to hold them for that long, 8.8, and if she gets through to 80 holding them, 12.94 million. So it really just highlights that power of compound growth, and something that can help us stay motivated to hold on to properties when we build out property plans in our software. So obviously that gives you a rough idea of what her portfolio value will be.
That's really interesting.
Yeah.
And if she lives as long as Moses, so we can tick off the religion thing, they'll be worth $100 million.
Well, yes, exactly. And she might part the seas. But so, and then if we look at the debt position, and this is the part that you can forget about when you own property, is if you do it well, that's not growing. Okay? But your asset value is.
And so your rents.
And so are your rents, yeah, which we'll come to and map that out as well. So, her debt, we understand, is at $2 million at the moment. So $850,000 on the townhouse that she's now moved into, beachside, and $1.15 million on the property she bought that she decided she didn't want to live in, and Bass. So at the moment, that's a loan-to-value ratio of 68%. Net asset value 920. But if we just project forward to the age of 60, her net asset value will be 3.36 million, 65, 5 million, 70, 6.8, and again 80, 10.94. So if we look at age 60, that's 3.5 times greater than the position she's in today. So that isn't too far away. So
and that's not counting any acquisition activity or external investing in other asset classes or anything. 100%.
Like that. It's purely looking at the property side of
things.
Yeah.
Awesome.
So like it just sort of, at that high level, if you keep your cash flow positive, your lifestyle isn't too detrimentally impacted, and your property value is continuing to increase, and there's going to be ups and downs. That's one piece of the puzzle that Alison should be trying to keep her eye on.
Yeah, I love that, and it just the numbers get better as time goes on. Obviously, not just from a capital growth point of view, and we'll touch on rents in a second. But that loan to value ratio, which is already, I would consider that a conservative loan to value ratio. For someone that's, still could be in the age bracket where you're in the acquisition phase, right? There's still quite a lot of time, depending on, as Cate said, what her appetite for that job is. But getting to rents, Dave, and maybe starting with you, Cate, of course, the two parts to the investment equation is growth and then income.
Yeah.
How can we understand the likelihood of the rental returns and what increase we could be sort of banking on?
Well, what we do know is that the rental yield, gross rental yield, is a little bit elastic, and it kind of hovers for a property like this in Melbourne. You'd expect it to have probably an equilibrium of around 3% gross rental yield, which means when property values are going hard and rents haven't kept up, it might drop down to maybe 2.6, 2.7. And then when rents fly and catch up and values sit still, like the last 12-month cycle we've been through, you would expect it then to push up to maybe 3.5. And I've seen some townhouses even get close to 4 because we've had a bit of an unprecedented catch up with rents. As Pete Kalizos used to say, we're catching up. But the reality is that relationship pretty much hinges around 3% for a townhouse in Melbourne, and other capital cities and regional towns will have different gross rental yields. Ours tend to be a little bit tighter than most in Melbourne. So that means that rents do broadly keep up with price increases, but not necessarily in tandem. And it sort of looks like a DNA strand, if you get my drift. So they're not always necessarily following the same wave, but they do broadly stay together. So if we're looking at a property like this that delivers, whether it's 5% year-on-year capital growth over the long term or 6 or 7%, dare I say it will be somewhere around that sort of range, then rents will keep up. And if you're getting in there with a microscope and watching your rents, well, they won't be going in sync with capital growth. But if you stand back and it's a long-term play, then in 10 years' time, your rents will have moved at a very similar pace long term to what your capital growth has. So if it's 5% year on year as a conservative estimate, or whatever we want to say, Alison can look forward to having that rental growth. And of course, what it ultimately means is that your debt position stays still unless you're accessing equity, which we don't recommend, unless you're still acquiring property. And your rents will slowly overtake to the point where you'll have a positively yielding property. It'll be positively geared. You'll be paying tax on it. Best news ever. That's the one time I love paying tax, when I flick over to positively geared. And Alison's earning such good money at this pace. If she can sustain that or even anything close to it, you mentioned the LVR word, Mike, that LVR could be driven down by really clever use of offset accounts and channeling that rent consistently into the offset as well, to the point where Alison will have a property that's grown in value and is delivering her a really attractive rental return. And I think a townhouse, a 4-bedroom townhouse, for someone who's not at the beginning of their career, but they're towards, not necessarily the end of it, but they're in the second half of their career, a townhouse is a great asset because it is going to give her moderated growth, not the same as a house, but it will give her stronger rent, and that could subsidise her post-retirement income.
And Dave, we're talking rental yields is always the rent over the value of the property, but if we talk about rent on debt, right, the yield is going to be so much better, and that's obviously in Alison's mind is how long it's going to be for it to be positively geared. But when you consider the value of these assets growing up over time, it's kind of worth chipping in a little bit, because you can just see by your sort of mapping where we're going to get to down the track. When it comes to the rental income versus things like land tax and holding costs, how much? Paint the picture for us. What does it look like on these investments?
Yeah, look, I think if we go through and paint what the numbers possibly look like for Alison, I think it's a good process to go through for our listeners. It does highlight a couple things. It does highlight how much land tax and holding costs eats into your rent, particularly in Victoria, for starters. So I worked off some numbers and had a 3% yield on the Beaumaris townhouse, as Cate actually was just using as the number, and I used 5% on the Bass Coast property, being a regional coastal property probably gets a bit of a higher rent. So we could ballpark, we know the values of her properties. She'd be earning about $65,000 gross rent today. Then we know the asset values are 1.8 million. So I'd say there's a reasonably high land value. I've gone with about 1.4 million across the two properties. So that would be a land to asset ratio of 78%, perhaps slightly high, but to work out her land tax. So her land tax would be $8,250 per annum. So there's 12% of her rent chewed up in damn land tax. Now, that's jumped up by a couple grand thanks to the Andrews government, which is part of what's driven her question and this fear around should I hold and is the government going to keep taking more of my rent? So there's 12% gone there. Now, if we assume about 1%, I've assumed just slightly over 1% per annum in holding costs. Now, the usual numbers people use is 1 to 1.5. So a bit over 1%, that's $20,000 in holding costs. So right there, we've actually got $28,000 in costs, which is 43% of her rent is chewed up in maintaining the properties and land tax. So this is it's a fair chunk, isn't it?
Yeah.
We haven't talked about the mortgage yet.
No,
that's a huge. I mean, I'm sort of stunned.
Now you're the right guy to help with this stunning blow, Mike, because obviously there's offsets here, and we can chat about that after Dave's run through the raw numbers. Because some of these taxes are deductible from the feds, which is it's mind blowing. But anyway, that's another story.
Yeah.
So yeah, we can claim the land tax as a deduction, and the holding costs, obviously, which we'll come to.
Right. So, if we're factoring in those interest costs, where do we land? I mean, yes, we've got the tax deductibility of land tax. We've got the interest portion of the loans. We've got some depreciation that's hopefully in the mix. Give us a call, Alison. I know a guy. But Dave, where are we looking from a cash flow point of view and chart us that path to positive geared property, because I think that's pretty important to Alison to have an idea about how long it's going to take to get there, and should she weather the political storm to get to that point.
Yeah. And look, and this is where she'll be feeling the pain, like so many investors. And we know anecdotally and on the ground, people are selling investment properties that otherwise would have had, and that's because rates have gone up so much. So if we work on assuming average rate of about 7%, which is not unreasonable now, with paying interest only on an investment loan across 1.15 million of debt, which is the amount of debt she has on the investment properties. She's paying 80,000 of interest per annum. Now that might have jumped up from 50,000. So, it's a big adjustment for our landlords out there. So that means, ballpark, she's negatively geared about $40,000. All right, and she might have only been negative, having to come up with like $10,000 or $20,000 per annum prior to this, and now it's jumped to $40,000. Now she will get a fair chunk of that back. She's running a successful business. She'll probably be in the top tax bracket.
I was going to say that'll be a massive tax bill.
Yeah, so she of that 43,000, she might be able to claim about 18,000. So the out of pocket expenses are probably 25,000 now. Now, one thing she can do, which you may not be aware of, is set up a tax variation. So she's paying less personal tax from a payslip each fortnight or month whenever she gets paid. So she doesn't have to wait to get that money back when she does the tax returns. And if she's anything like me and most self-employed people, we don't do our tax returns till about 9 months after the end of the financial year.
Add one thing about the Section 1515. It is a consideration if cash flows are tight and you're wanting to manage that, but you've got to have your estimates absolutely spot on. So your books have to be really up to speed, and you also have to factor in your additional cost of managing that, because you'll need an accountant on your side.
That's a good point. It's a much easier thing to do if you're an employee, whereas if you're like us, business owners, your income's so variable.
Yeah.
Feast and famine, and I think it's always better to overestimate underestimate the tax deductions and the benefits that you get, because I'd rather sort of be a little bit conservative and have some money back rather than a bill, and that's something that I've heard from accountants before, is that people would sort of err on the side of, it's, costing me this much. And then they're like, actually it wasn't that bad. And now we have a bit of a tax bill. But an accountant needs to be in the mix, right?
100%. And, ideally you don't do the tax variation at all, because it's forced savings and you get that bonus at the end of the year when you do your tax return, which is
the only thing is the ATO don't pay you interest on the holdings.
No, that's true.
Yeah.
Yeah, this could be
Disappointing.
your offset account.
So, in terms of the rental growth over time, to charting this path back to positively geared, what does that look like for us, Dave?
Yeah, so look, the good news for Alison and all investors out there is the rent grows over time, even though your debt shouldn't, just like the capital growth, which we've just worked through. So at some point, you will become positively geared, and then, as time goes on, that rent will significantly outstrip your holding costs and it'll spin off money. So look, what does that look like for her? So project will have jumped up from 65,000. Looking out some numbers, at age 60, the rent went to about 120,000. So that's almost doubled in the next 13 years, and that's at 5%. 65, 156,000. Now, also, let's keep in mind we might be at the top of the interest rate cycle. So the interest payments might start to come down over that period of time.
So.
Yeah.
Bloody hope so. Yeah. Not too much, because the economy's in a bit of trouble, but maybe just a little bit. So would be nice for everyone. And then age 70, 196,000. Age 80, a whopping 305,000 in rent. So, yes, look, your holding costs and your land tax are probably going to increase relatively, but your interest should be staying the same or hopefully reducing. Once you've paid off the debt on your home, you start reducing the interest. So, again, it's about painting that long-term picture. Here's where you can get to if you can get through those ups and downs of life, which we have to live through day in, day out.
Yeah.
And again, it's why we should support people who make this decision to, take on the risk of, buying investment properties that provide stock and creates a reason for developers, another reason to build new supply, which we need. If you don't have investors buying, there'll be less new supply.
Yeah, investors really stimulate that supply. Cate, given the fact that this Victorian land tax change hasn't sort of been grandfathered, i.e. if you bought beforehand, you don't have to worry about it. It changes the metrics for when someone like Alison can go from negatively geared to neutral to positive. Do you think that has ramifications for investor participation that will exacerbate the rental issues we're facing?
Yeah, without a doubt. I want to add some perspective to this, though. The first thing I'll say is it has been signed off, but it hasn't started yet. It starts in July next year. And if we remember, the ridiculous land tax that Queensland dreamt up was repealed before it started. And in the wash-up, a lot of people fled, and we actually listed our Queensland property for sale and then quickly withdrew it when it was repealed, because the impact would have been ridiculous on our cash flow. And it was a very different proposal to the Victorian one. But first and foremost, it hasn't started yet. Could it be repealed? Maybe. It's a stupid idea. They've wasted $380 million on backing out of the Commonwealth Games. I think that our state has demonstrated that they're very good at mismanaging money, and this little clawback is not a popular one, and it absolutely is having an impact on investor willingness to participate in Victoria. The sadness about it is, while it's a stupid tax and it is annoying and it will delay someone's ability to have their property go cash flow positive, it's not a massive tax burden for a local. It is a massive tax burden for someone overseas. I would hate to be a foreign investor and copying this alongside some of the other foreign investor taxes that have been thrown, but that's a different story and a different angle. So putting it in perspective, for Alison, as you said, Dave, it's probably an extra couple of $1,000s, which is horrible, and that's real money for a lot of people. But in the scheme of things, when we compare it to the capital growth that she looks to enjoy if she can hold it, it is a little bit of a drop in the ocean. So if your salary or your wages can tolerate this stupid temporary tax and your property is a good property, I wouldn't let the tax put you off holding the investment. And I wouldn't let that put off people that are looking to invest in Victoria from investing, because at the moment our prices are lower than a lot of the other capital cities for good reason, and the disparity from let's say Sydney, it's the one that we always contrast it to because we like looking at that ratio of Melbourne median values to Sydney median values, and it's pushed right out at the moment, which means that Melbourne could potentially be a really good opportunity because you're buying in a bit of a depressed market that has the capacity to bounce back. So, yeah, I don't think that this has helped our cause at all for rental numbers in answer to your question, Mike. But I also think for any investors who can sustain the additional land tax, which can be claimed against, your income tax, I don't think that you should.
Yeah. It's quite a small percentage for
it's doable.
investors.
It's a stupid tax. That's all.
It might be a 10% increase for most people. Own 1 to 3 properties, that's probably a $500 to $2,000 increase.
That's right,
per annum. But it unfortunately has, I think, an outsized negative perception and the optics, if you like.
Oh yeah,
particularly interstate potential buyers. But again, that, as you're pointing out, Kate, that could create opportunity for people who buy,
who see the opportunity. Look, there are some other things that our state government have done that I think are harder on investors than this temporary tax. I think the rental reforms have been really hard, and some of them are great. Don't let me suggest that we shouldn't have reform, but some of them are really silly, and taking away control of someone's asset is a really dangerous thing to do when the number of assets out there that are available in the rental pool are already limited.
We keep saying this, but not the right people aren't listening. I mean, our dear listeners are listening, and our viewers on YouTube. Check out our YouTube channel because you get to see behind the curtain, like me holding up a hand to say we're running short of time. But yeah, the politicians aren't listening.
Was that 5 or 10?
We're up to 31.
The hands are out there.
Yeah, we got 5 minutes to go.
So Dave, we've talked hold. Now, Alison might get to the point where she's weary, she's wanting to cut down on work, she's not wanting to stomach that negative position. Let's talk about the merits of selling. I think we're kind of all on the same page that it would be great to hold on because the numbers just seem incredible if she can get to 60, 65 or 200 like Moses. But devil's advocate, what does selling look like? How would you recommend selling down some of her assets?
Yeah, look, I mean, she very well may choose to sell, but first we had to explore what her position could look like over the longer term so she understands that, because most people don't. Most people don't have access to a property plan and this kind of modelling, and so, it obviously helps build that motivation to hold. But if she does sell, I think, the Bass Coast property, given where it's located, is possibly the one that's more likely to underperform from a capital growth perspective. And also the other thing is, if she was to sell that one first, she's still holding on to a greater asset base with keeping Mentone and Beaumaris. Therefore, she's not, the compound growth, both in the asset value and the rentals, will be in her favour because she's keeping that stronger asset base if she sells Bass Coast first. So that's probably the first point I'd make. And then the second point basically is, look, if you can hold until, you've slowed down your work or even retired, well, then the capital gains tax is going to be a lot less because, you're earning a much smaller income. So it's going to be being paid off a smaller tax bracket, or even in the tax-free threshold for the initial dollars as it works its way up. So the other aspect there is, if you do sell both of them, to stagger it and try and sell them across multiple financial years for the same reason, so you're paying less tax on the capital gains tax. So there are a few of the key points when it comes to selling. And remember, the longer you hold on to the properties, the more cash you're going to have to play with to live off and or invest, before you need to sell the next one.
Yeah.
And Cate, for anyone that's listening to the show that is seeing themselves in some of Alison's quandary, have you got any final thoughts before we go to our gold nuggets?
Yeah, I do. I think it's very hard for us to sit back and look at this and digest it and give advice. And of course, this is not financial advice. It's just indicative thoughts around how we would tackle things without knowing all of the nuts and bolts. I don't know whether Alison's ultimate dream is to enjoy the beach house down in Coronella or Kilcunda or wherever it is down the Bass Coast, or whether there's a plan there to ultimately, sell it. We're making a couple of assumptions there. But, one thing that Dave mentioned, which I'm a big believer in, is try before you buy. Could have Alison avoided buying the 4-bedder that ultimately they moved out of if she'd tried before she bought? Yeah, maybe. But I would also say that from an investment point of view, a 4-bedroom townhouse is going to deliver you more rent as a proportion of its value than most other dwellings. So this one could be an absolute corker as a performer for long-term rental return. I'm really reluctant to see Alison sell at all if she can help it. And you can hear that in all my pleas. But I also respect that, single parent running a business, obviously working very hard. They're really good incomes. It might not be sustainable for her well-being or happiness or health to continue working at that pace. I don't know. But if there's a remote chance that it is, I would implore Alison to have a look at some ideas that could reduce her stress. It might be locking in the interest rate and fixing it, and albeit paying a little bit more than what we've seen in past years. But if it gives her peace of mind, then that's one thing. The other one I'd consider is maybe Airbnb the Bass Coast property. It might be suitable as an Airbnb, and you could look forward to even greater returns. I know that Dan's having a chat about
I was just
a levy there
say,
as well. But
Dan has got that one in his sights, despite there being recent research to say that Airbnb has a very, very limited impact on housing affordability and rental affordability.
We provided that research.
Yeah, you guys keep voting for him, so I don't know what to do. Like, just move to Omery and relax.
The jobs in the state are linked to the work jobs for the government, so that won't help.
Dave, before we go into the gold nuggets, any final thoughts from you?
Oh, look, I just think, it's always worth considering try before you buy when you're moving to a new location that you haven't lived in before, so you don't end up having to get in and out over the short term. And we know the costs of getting in and out of property in Australia is so expensive, and because of stamp duty predominantly. So that's one thing. The other aspect there too is if she did decide to buy a second investment property instead of buying a home that inadvertently turned into an investment property, she could have considered buying interstate, and then that would have been a way to manage her land tax. So her land tax spread across, because it's state-based, could have been reduced by about $5,000 or even up to $8,000 per annum, depending on the price points and the land value. So, and that would have provided her a bit more diversification, which can help manage different market cycle risks, etc. And certainly when you've got a high level of debt, locking in, it just buys you certainty over a period of time, which can just help you sleep at night as well. So there are a few of the little sort of considerations.
Yeah, it's hard to. In hindsight, that might have been a better decision for her, but it's sort of hard to know sometimes. So the try before you buy is a good approach. But for Alison, it could be a very lucky decision, given that Cate sort of rated that as a pretty good investment property over time.
Yeah, I think it's a good accidental investment, that one.
Yeah.
And look, it might, but if she can hold on to them, it might have been an extra property decision she never would have made in a lifetime.
Yep.
That means she ends up with an extra couple $1 million of wealth in retirement if she can hold on to it. So
exactly.
One of the hardest things to do with property is just buy it.
Yeah. I honestly think that if she can hold on and get to retirement age, it's party at Alison's. Get those, send those out when the time comes, and we'll drink you out of margaritas, Alison. We're looking forward to it.
Absolutely. I think she's the first listener who we've answered 2 questions for. So
I love the follow-up. It's great.
There you go. We get we get paid in margaritas. It's that wonderful time of the show again where we go to the gold nuggets. Now we've unpacked quite a lot of nuts and bolts with Alison's situation, so I want to hear from you guys for your gold nuggets in and around her situation, or some of the nuances of situations like these for investors.
Now it's time for us to go mining for our gold nugget property tip of the day.
Well, look, for me, I think, the starting point for any successful property decision is understanding the numbers and the long-term implications for any options and choices that you have in front of you. And a lot of people just don't know where to begin. So the beauty of the property planning platform that we use is that once you've built out a property plan for your client, for yourself, and we educate them on how to use the platform, they have lifetime access to the platform and are empowered to work through these decisions as they arise themselves. They can build and contrast multiple scenarios. For Alison, she could meld to retirement. What if she sold one property map out? What will her end position be? If she has property now, what if she sold the other property first? What if she waits for 5 years and sells one or the other and holds on till 70? You can map out multiple different pathways. So it just allows you to actually look at what that can look like, and then you can update it in real time and adjust it over your lifetime. So and compare and contrast these pathways to one another. So it's just a powerful tool that puts you in the driver's seat that most people don't have access to.
Yeah, to be able to make educated decisions based on real numbers and yes, projections, but you can make conservative projections or you can be optimistic and see what the difference is there as well. What about from you, Cate?
I want to use a personal example as an illustration of the power of time. I remember when I purchased a property down in Hobart as an investment, and it was the largest amount of money we had spent on any of our properties in our portfolio. It wasn't super eye-watering, but it was a little bit scary for both of us. We spent $560,000 back in 2008, which was no mean feat, especially in Tasmania. That was well above median house prices down there. And this property was picked by me as a property that would absolutely perform for us long term. So we chose it. It's in the grid. It's in Hobart itself. Big 4-bedroom house. It's got some period charm and really easy walk down to the city, but we had to pay for it. And at the time, I think our rent was around $375 a week. And it quickly got to $400, and I remember getting really excited because we were getting that rental growth immediately, and it was having a nice impact on our cash flows. It was still a negative cash flow property. Fast forward to today, that property is now delivering us $850 a week in rent, which is just over $44,000 of rent a year. That's one property in the portfolio. We hung on to it for the long term. And you can always project what the property will be worth itself, but sometimes you neglect to project the rent. And it's well and truly cash flow positive. We've been able to almost pay that property down in full. So my message to Alison and to anyone else who's thinking about hanging in there for the long term and dealing with the pain, it's not just asset price growth that you get to enjoy, it's the rent, and it really does keep up.
I love that. It's not just your Eastern European resolution as Cate Beckosh. It's a case study from your own portfolio. Look, I think to finish off from me, I always think about the carrot and the stick. The stick is the tax, right? And the carrot is a little bit harder to focus on because the stick sometimes really hurts. But you don't want to throw away the carrot. Now, what is the carrot in this metaphor? The capital growth, the projections that Dave's looked at, because you're worried about, $8,000 of land tax. If you do the numbers and you can look at it objectively, you can go, yes, this stinks. Yes, I hope this tax gets repealed. But even if it stays in place, on the long term, it's a pain, but it actually still makes sense for me to hold these properties. So, Alison, I hope that you're resolute with that. I hope we've given you enough to consider there, and you've got some really some good value out of that, and hopefully the listeners have as well. Thank you, Cate, and thank you, Dave, for all of the analysis you've done today, and we'll see you next week.
We'll see you guys
See you
next
next
week.
week, everybody.
Thank you, Alison.
Cheers.